Well, we joined the New York Exchange in 1981, many years ago. And so prices then, when we first came on board, we were about half price. We kept coming down every year to now. It was sort of the final solution for investors. We have a great deal for investors.
Not many people know this, but investing in dividends might not be as hard as they think. Today, we're going through the SCHD, the Schwab U.S. Dividend Equity ETF, known for its market-beating returns and robust dividend growth. And the best part is that with the power of the dividend snowball effect, you don't have to invest a hefty amount to be able to live off dividends. This fund not only offers a straightforward, low-cost way to grow your wealth, but does so in a way that might surprise you with its efficiency. And more importantly, at the end of the video, we will calculate how much you really need to invest to live comfortably off dividends. Stick around because the answer might shock you. For that, we first need to understand the concept and history of SCHD to get an idea of its performance. The Schwab U.S. Dividend Equity ETF offers an appealing mix of steady dividend income and potential for capital appreciation, making it a favored choice for conservative investors. Launched in October 2011 by Charles Schwab, the ETF aims to track the Dow Jones U.S. Dividend 100 Index. This focus reflects a strategy that prioritizes high dividend yields alongside sustainable financial practices. SCHD's investment strategy is built around a stringent selection criterion that prioritizes high-yielding stocks from companies with solid financial health and a reliable dividend payment history. This strategy ensures that the ETF is composed of strong companies capable of sustaining payouts even in fluctuating markets. The ETF's philosophy is particularly attractive to those who value income along with moderate growth in their investment portfolios. Historically, SCHD has shown commendable performance metrics. Since its inception, it has posted an average annual return of over 13%, which is a robust figure in the dividend-focused ETF market. In the last 10 years, the ETF obtained a 11.62% compound annual return with a 14.51% standard deviation. This performance is supported by the ETF's resilience during economic downturns and market volatility, where it often outperforms broader market indices due to its focus on large-cap, financially stable companies. This historical data indicates a consistent increase in its dividend payouts, reflecting the growing profitability and cash flow stability of its constituent companies. This trend is a positive indicator of the ETF's potential for sustained income distribution, making it a reliable option for investors seeking regular income streams. Another significant advantage of SCHD is its low expense ratio of 0.06%, making it one of the most cost-effective options in its category. This low cost of investment management directly benefits investors by maximizing the net returns on their investments, further enhancing the appeal of SCHD in a competitive market. The recent market performance of the Schwab U.S. Dividend Equity ETF highlights its resilience and continued appeal to investors, as evidenced by its impressive asset base and positive returns. As of the latest data, SCHD manages a substantial asset base, totaling approximately $56.46 billion. This large asset base is indicative of the trust and confidence that the broad spectrum of investors place in the ETF, reflecting its reputation and perceived stability in the market. The ETF has recorded a year-to-date daily total return of 5.27%. This figure is particularly notable given the broader market context, suggesting that SCHD has successfully navigated recent market volatility better than many of its peers. The fund's focused management and strategic asset allocation on high-quality dividend-paying stocks is a big reason for its success. SCHD offers a current yield of 3.31%, which is competitive within the category of dividend-focused ETFs. This yield is attractive to income-seeking investors, particularly in an environment where interest rates on safer assets like government bonds remain relatively low. The yield reflects not only the dividend payments from the underlying stocks, but also the ETF's ability to maintain these payouts even in fluctuating market conditions. The combination of a strong yield, good total returns, and substantial asset management shows SCHD's position as a leading ETF in the dividend space. It continues to attract investors who are looking for a blend of income generation and potential for moderate capital appreciation, making it a favored choice for long-term investment strategies. These details illustrate why SCHD remains a significant player in the investment landscape, particularly for those who prioritize income alongside growth. Its performance, particularly in the terms of yield and total return, positions it well within the competitive ETF market, offering a promising option for both current and potential investors. Now let's move on to understand the dividend snowball effect and how it can help reduce the initial investment amount. Have you ever watched a small snowball grow as it rolls down a hill, gathering more snow and gaining momentum? That's a perfect metaphor for the dividend snowball effect in investing. When you reinvest your dividends, you buy more shares of the stock or ETF, which in turn generate their own dividends. Over time, your income stream can grow significantly without any additional investment from your pocket. This compounding effect can be a powerful tool for long-term wealth creation, particularly when utilizing a good dividend-paying ETF like SCHD. SCHD is particularly well-suited for this strategy due to its focus on companies with a solid history of paying dividends. These aren't just any dividends. These are dividends that grow. Investing in SCHD means your portfolio isn't just static. It's dynamically increasing in value and yield, creating an ever-growing income stream. Here's how SCHD enhances the snowball effect. Number 1, as we discussed earlier, consistent dividend growth. SCHD holds companies that have a strong record of growing their dividends year over year. This means the dividends you reinvest are likely to be larger each time, accelerating the growth of your investment. And number 2, stability and reliability. The ETF's constituents are companies with long histories of financial health and dividend reliability. This stability is essential when dealing with market volatilities, ensuring that your dividends remain consistent. Let's break down a simple example to illustrate the potential of living off dividends with SCHD. Suppose you start with an investment in SCHD that generates an annual dividend yield of 3.31%. If you continually reinvest these dividends, the compounding effect kicks in. Over the years, as the dividends increase and you accumulate more shares, your annual income from dividends can grow to a sizable amount. So imagine this. You start with $100,000 invested in SCHD. With an initial yield of 3.31%, your first year's dividends are approximately $3,310. Reinvesting these dividends buys more shares, which themselves will generate more dividends the following year. Assuming the dividend growth rate and yield remain consistent, and factoring in the average total return of the ETF, your dividend income can potentially double every 7 years. This isn't just a theory, it's a practical, achievable result that many investors strive for. The dividend snowball effect is not just a theoretical concept, but a practical strategy that can lead to real financial independence. By choosing a vehicle like SCHD with its solid dividend growth and low expenses, you can set up a foundation that can support you in the future. Now consider your own financial goals. How could starting this strategy today help you build towards financial freedom? Think about it and maybe take that first step towards creating your own dividend snowball. To achieve this, you must determine the amount and duration of investments necessary to support yourself solely on dividend income. So now we're going to explore exactly how much you would need to invest monthly to live comfortably off dividends in 20 years, based on current financial figures and the performance of the SCHD. Let's use the average U.S. annual salary as our target income, which was $59,384 at the end of 2023. This figure will help us understand the investment required to match this salary solely through dividends. Firstly, we must consider the impact of inflation, which erodes the purchasing power of money over time. With an annual inflation rate of 2%, the value of money decreases, meaning that you will need more in the future to maintain the same standard of living. Therefore, in 20 years, that average salary of $59,384 will need to be adjusted for inflation. After 20 years at 2% inflation per year, the equivalent needed in future dollars to match today's $59,384 would be significantly higher. To calculate this, we apply the formula for compound growth of inflation. This would make your target annual income approximately $88,120 in 20 years' time, and it will have the same purchasing power as today. Now let's calculate how much you need to invest each month in SCHD, assuming the average annual return of 11.62% and a dividend yield of 3.31%. This part involves understanding the growth of your investment and the income it generates. When you invest in SCHD, not only does your capital appreciate, but the dividends can be reinvested to purchase more shares, thus increasing your potential dividend income each year. Let's assume the total return remains consistent at 11.62% and you reinvest all dividends. To determine how much you need to invest monthly to achieve the target annual income from dividends alone in 20 years, we will use the future value of the annuity formula, which takes into account regular investments, the return rate, and compounding frequency. According to this formula, starting from zero, you would need to invest approximately $1,500 every month for the next 20 years at an 11.62% annual return rate to achieve an annual dividend income of $88,120. So imagine this. Every month, you set aside $1,500, just like you might do for a mortgage or a car payment. This money goes into your SCHD investment. Every dollar investment starts working immediately, earning dividends, which buy more shares, which then earn more dividends. It's like a financial snowball rolling downhill, growing bigger and faster over time. By the time 20 years have passed, this disciplined, consistent approach could potentially cover your annual living expenses without touching the principal. The idea of starting small and growing your investment patiently over time can lead to substantial financial independence. By leveraging the power of the dividend snowball effect through SCHD, you are setting up a sustainable, growing stream of income that could support you in the future. Think of it not just as saving, but as building your financial freedom 1 month at a time. Why wait? Consider taking that step today to secure your future. And if you have any inputs to help the community, please drop them in the comments section.